right, so stocks finished today relatively flat, sideways. Some stocks down, a lot of stocks down. Some stocks down a lot, but a lot of stocks up too. And so the indexes themselves up. I think the S&P 500 finished just barely a few points shy of an all-time high, and so it wasn't a bad finish to a holiday week. Of course, you have a half day on Friday, but more than likely, most of the holiday week now is over with, and now we have next week, right after Thanksgiving, going into the Christmas break. So I'm going to talk about today's video what we expect to see next week, going in. What looming signs are out there, but what do we expect? Do we expect more weakness next week? Do we expect the weakness now to be done, or at least the volatility that we've seen here lately to be done? So I'm going to show you what I expect and why, what charts I'm looking at, what they're saying. And then we're going to take a look at a stock itself that's kind of been on its own upward trend, and then quickly shifting to a bearish trend, and then back to neutral. And it's kind of a representative of one of the major sectors that's out there kind of influencing the markets, especially with the move in yields. So we'll talk about how to trade it. So let's go ahead and get started. Today is Wednesday, November the 24th, 2021. This is the market outlook from MarketScholars.com. My name is David Settle. All right, so really quickly before we look at the market forecast indicator, I just want to remind you about our Black Friday sale. You can see it on our website up here at the top, this big banner. We are offering our premium service for 20%. We don't do this throughout most of the year, so this is the time of year that we do this. So this is when we get most of our subscribers as a result. So we do offer a 20% off sale for Black Friday coupon code there. Then you click on that link to join. If you want to see what we offer, there's all the different things that we have the offer there. If you click on subscribe down here, you might have to, if you click on that, or you can just click on premium right there. That takes you to this page. You can kind of, this shows you how you can sign up, as well as you can see what, why some other people here are part of our service. And you can also see too that you can spread the payment out over 6 months, same as cash with no interest, by going through PayPal. And there's the instructions on how to do that there. Remember the coupon code is, if you click right there at have a coupon, you type in your code right there. So it'll be Black Friday. B and the F are capitalized, all one word. And then if you wanted to try to do that PayPal, you have to sign up for their credits, not through us. So you have to sign up for their credit on their account, and then log into your account and then pay using your PayPal account. Otherwise, you can use your credit card right there. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. And you can see the bounce up. In fact, 2 days off of lows in a row, 2 consecutive up days, even if we gap down on both those days. That's bringing both the short-term sentiment lines up. They're out of bearish territory at the very least. They're not necessarily in bullish territory yet. They're both kind of neutral. But at least they're out of bearish territory, and that's maintaining the current bullish posture right now that you see. Again, above the 90th percentile, and market sentiment rising above the 70th. I mean, that's a bullish trend. Obviously, we've been converging as we get closer to the moving average. But that doesn't, I mean, it's obviously we're not in intermediate pullback mode at all. We're still easily above that 23% retracement level. Of course, that's also the same for the NASDAQ 100. NASDAQ 100 came a little closer to flirting with the 23% line. Let me get rid of that line there. But it's still up above it, so we're still in short-term sentiments bouncing, not as high, still in bearish territory, but we still have a strong bullish posture. We still have rising long-term market sentiment. A little different scenario for the Dow and the Russell, of course. It's like we saw last time. Short-term sentiment did bounce a little bit stronger for the Dow Jones. A little bit of a long lower shadow after a good strong bounce yesterday. Still got light pink shading, yellow line, which is a bullish pattern. We are below the 23% retracement, so that's unique right now to the Dow of this rally, of this intermediate run that we're on. Its market sentiment, or intermediate line, is still in bullish territory, but not up above 80, and it's crossed below today its market sentiment line. So kind of a death cross, obviously a lot closer to the moving average there. And then you look at the Russell 2000, and you can see its intermediate line is in neutral territory. It's out. It crossed below its market sentiment a few days ago. It's well below its 23% retracement. Even if you were, you can see kind of, if I were to use the same starting point Russell didn't get going, but if I were to go all the way back to 10.4, which is about the starting point for the S&P 500's run, so that would take us back to 10.4 would be right on this day here. So 10.4, so it's technically 10.6 with a lower low. So if I try to do a similar low point down there, looks like that was the lowest low point of this whole time. Even there, you're still easily below the 23% retracement, and in this case, well below the 38% retracement. So you do, but again, light pink shading, the yellow line, that's a bullish bounce signal. Short-term sentiment has bounced, but just barely out of bearish territory, so it's still relatively neutral. And of course, until you break below 50 is when you get the dark pink shading, and if you have to be more than 0.5% below the 30-day moving average, you get to roll over. So this is hardly in and of itself a bearish signal. And again, this would be a pattern that you would expect us to bounce off of, right? This low point we would expect to bounce off. Whether we get to new highs or not is a different story, but at least we would expect to bounce off of these lows based on the pattern, especially considering that we're not that bearish. Now, if we were at the lows of yesterday or today, that's a different story. But we didn't. We finished well off the lows on both days. We got a little bit of long lower shadows there. You can see a couple in a row. So it's not as bad, and sets us up for maybe a post-Thanksgiving bounce. Even disregarding what happens on Friday morning, unless it's a significant move Friday morning. Half-day trading, very low volume typically. So I wouldn't put a lot of stock into what happens Friday anyway. But so post-Thanksgiving, this pattern would suggest that we should get a pretty decent bounce coming out of it. Here's the long-term crossover chart for the S&P 500. Obviously still above the moving average, still got a positive differential even if it's down below its moving average, and the PPO is still rising. For the Russell 2000, remember we have a negative, the PPO is actually dropping. We have a negative differential, and we are that close to getting a red arrow on the 10-week exponential moving average. So we're kind of flirting there with intermediate pullback on this chart for the Russell, but not quite there. Same thing with the Dow. We're not getting the red arrow. We do have a negative differential. We do have a falling PPO. We don't have that red arrow yet, so we're not. We're below 23. We're kind of at that mode where okay, we can bounce off of this and still not technically be an intermediate pullback. Here with some of these other indicators. Looking at the 3 green arrow charts, you can see we got clear and clear, and we still got light pink over here. So that's a little concern, the fact that we're 3 days in a row, and what is this would be 1, 2, 3 out of 4 days of light pink shading. Again, usually you get just one and we bounce. So the fact that we haven't bounced yet may be a function of the holiday week. So again, that's why it's let's see what happens Monday and Tuesday, whether we return back to clear and eventually back to green. It's going to take a little bit of time to get back to green because your MACD histogram is so low, but at least the histograms are rising. So again, another suggestion that we might come off of these lows rather than extend them with a more of a divergence. If you take a look at the 2-line version of the S&P 500, we are obviously still in convergence mode with the MACD below its moving average. Stochastics is dropping, but still in bullish territory. But we are still above the 17, and for that matter, with the close above the 8-day moving average on SPY, and the same thing with QQQ here. You can see closing a smidgen back above the 8-day moving average, despite the bullish convergence. For the diamonds, for the Dow Jones Industrial Average, we are now 1, 2, 3, 4, 5 days below the 17-day, and that MACD is just a smidgen below 0. So we're not quite diverging to the downside yet, and we're flirting with the 30. So this is, again, and we've got strong support below us. So we should bounce off of this. If we don't, then we might be in a little bit of trouble. And granted, we have a lot of volume between now and the 200-day moving average. We won't be sliding through here like melted butter. But it's just something to consider. We are 2 days now below the 30-day move, 3 days, in a row below the 30. Again, might be a function of the holiday week. We did fill in the gap between the 30 and the 50. We have not crossed below the 50 yet. We got a lot of volume support down here. The problem is if we break the point of control, there's no volume support. So we are a lot closer to getting below the point of control on IWM than we are on SPY. See how far up above the point of control we are. and then the QQQ way up above it there, and then QQQ, and then the diamonds. You can see, like IWM, are a little bit closer. So it's when you get below the 200, the point of control, that's when things get more bearish for whatever you're looking at. And in the case of diamonds, we can get below it and still be above the 200-day moving average with a lot of volume support. In the case of IWM, if you're below the point of control, you're also below the 200 and there's no volume support. So it's very dangerous. There's very little margin of safety for IWM, and there's a lot for the Qs and for the spiders. So again, but you can see the MACDs is a little bit below zero. The histogram's already turning up, so it doesn't look like yet, even though we've been down 1, 2, 3, 4, 5 days below the 17-day as well. It doesn't quite look like we're going to diverge. There's a chance that we can bounce off of this. So again, Monday, Tuesday, if we don't bounce back up above the 8 and 17 days, that quick, then look for more of a divergence across a lot of these other indicators. I expect that we'll bounce, right? I expect support to hold until it doesn't, and so I expect that we will bounce off of this coming out of the holiday week. Let's take a look at the intraday chart. So there's your SPY, lots of gaps filling in. Today's was a higher high, a higher low. We closed above yesterday's high just a little bit, but we closed at the high of the day, above yesterday's high, above the 4-week point of control. So good close for SPY. You can see QQQ, same thing. Didn't quite get up above the prior day's high, but at least we closed near the high of the day. So not as bearish. Looking at the diamonds, you can see it's an inside day. So we have been having bearish days. We have an inside day today, closing at the high of the day. Very a potential for a reversal pattern there, and pretty much a relatively inside day too on IWM after getting some bearish candles and now closing also at the high of the day. So below the points of control for IWM on the 4-week chart and for the diamonds, but it looks like their bearishness may be waning, right? It looks like there's a really good opportunity to get back above this, like I said, early next week. So I expect that we will. There's a low probability that we won't, and if we won't, then we're most likely are headed to more of an intermediate decline. And there's some signs of that being not as low a probability as a lot of people may think there. Let's take a look at today's volume and trading range, and not surprising here that today's volume was lower than what we've seen going into a holiday, but still a little bit above average at 61 million. Today's trading range was also above average there at 4 points, with filling in the gap. So let's put those numbers into context. 4 1/3 points roughly, and 62 million shares traded roughly. So that puts that's the volume is going to be a little bit above the average, which is a very low average, and 4 1/3 points is right about there, also above the average. The bigger the numbers, and it's not quite above 1%, so not, it's not bullish, but it's also not bearish either. And so, like I said, we might be setting up for a little bit of a support to be forming at these lows, at least a near-term support. You can see we're back to 85% after kind of hitting maybe a little bit up to 90 and coming down all day today, down to the lows of the day. Pretty much finished at the low of the day for volatility. So a good move, and so that opens this window up to trade in post Thanksgiving. If we bounce off of this, and it's a breaking through 90, that will be significant. But more than likely, you can see now it looks like the peak has been formed, and the window is now open for us to come back down into this 15, 16, 17 area for volatility. One thing to look at with the VIX is that we were above the 200-day moving average the last couple of days. Today we finished below it with a big long upper shadow. So that generally leads to more weakness coming up. We're just, we got the 15, we got the 8-day coming back. So let's see if we can get back below these moving averages here with that histogram rolling over coming into the weekend. Again, if we start to fill back in that range and stay above the 200 for another day or two, then it opens the door for this kind of jump in volatility where the DMI here, the DMI for the VIX gets up above 40, right? So, here's the jump we got. Not very high, but it did get a little bit. It got up to basically about 30. So now, again, we'll probably start to move our way back down into neutral territory here. So back below 25 and work our negative indicator back up a little bit as we grind back down to the downside. So to summarize, we've been weak. We've been weak, especially in kind of these cyclical areas. But the weakness appears to be waning. It doesn't appear to be building. It appears to be waning. So it's setting up for a good short-term bounce on Monday. Again, whether it leads to glory days ahead, obviously it's not, hopefully we're not that black and white where either we're super hugely bullish or we're insanely bearish and the sky is falling. So what it looks like now is that we're not very bearish, that what bearishness we've had here recently is waning. I wouldn't expect a lot of bullishness either. Bouncing up. I expect that the bullishness that we've had to start waning too, as we're still in convergence mode on a lot of these major indexes. So expect some bounce. Expect move towards highs. The S&P I think came really close to an all-time high today already. So expect the Russell and the Dow to get back to closer to theirs. But don't expect a big move like we've seen with large momentum. Like we're in waning momentum on the longer term. But even if the short term bearishness momentum is waning, the longer term bullishness that we've had over the last couple of months is also waning. So we're just going to continue to grind potentially into that December expiration and the holidays. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked the video today and you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. Or watch, for that matter. Also, while you're down there, comment. What'd you get out of the video today? What stood out to you? What questions or comments do you have about what I brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there on the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, right here, then check out some of these other things on the right. If you click on Market Outlook Live, it takes you to this page. You can see we've already done it for today. It's already posted here. This is where I review all the trades I've done in previous Market Outlook videos to see whether we should stay in them or get out of them. So we follow up on them, which is, I think, probably more important, the most important part of the trade that not a lot you get from a lot of people. So that's where you can get it from us. We also put on today's trade idea already, the one that you'll hear at the end of the video. We already put it on here during this. It's at 3:30 Eastern time on this page. You can also get to it up here by clicking on mousing over Market Outlook, click on Live Trade Review. You can see the archives down here. Click on, you can see our upcoming classes. If you click on View More, that takes you to our calendar. You can see all of our upcoming classes down here, as well as all of our recordings. You can also get to it by clicking on Trading Rooms up here at the top. Come down and click on this heart icon. Whoops, sorry. It opens up a new tab here. Hit that like button. Also click on this thumbs up icon. It opens up another new tab. Hit that like button again. The more you do that, it really helps us out because it gets all of our content out to all of our followers on these accounts, so that make sure everybody's getting our content. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. Also, really quickly, you can see our trading rooms descriptions down here. If you click on this image and the popular posts, that's our current trading rooms and what we're doing. And then for all of our new premium, we're getting a lot of new premium subscribers here with our Black Friday sale at the top. You can get to all of your chart links and how to set them all up, what we use in our classes and stuff on that page right there. All right, now let's take a look at what's driving this price action. You see today's move is really a big significant move in safety trades, whether it's long-term bonds, whether it's the US dollar, which can act as a safety trade at time, most of the time. Also, you can see the Qs outperformed, so they've been a safety trade too, lately at least. But down here at the bottom, you can see commodities, small cap stocks, emerging markets all lagged. Developed markets lagged the most today, but those three in particular are the risk trade lately, and they did finish off their lows, but still all out underperforming these more safe haven oriented asset classes. This is a big move up on the dollar. Remember, the dollar's been on this parabolic move to the upside. That's obviously continuing as the positive directional index is now up to one of its highest levels that we've seen, at least in the past year. If I go back out to last like 10 years, for an example, you can see here that the positive index has been up here a few times in the past, usually during kind of more bearish runs. But you can see kind of at the beginning of that 2000, or at the beginning of some rallies as well. The negative index doesn't usually get this low. So if you follow my cursor all the way over, last time the negative index got this low was back at the very beginning of this bullish run, way back here. It usually doesn't get down to the 10th percentile. So for the dollar to be this bullish is pretty insane. And of course, a lot of it's euro weakness. We've talked about that before. The euro is has broken down below this 13.75 range, is down to 112. So it's still at that blue line. This blue line is, if you want to see here really quickly, that blue line that you see drawn there is this big long trend line coming down that we have broken out above post-COVID. And then we've now pulled back and are now testing it as a support. And you can see the negative. Look how this is the weekly DMI. Look how low the positive is now, high the negative. I mean, we're not above 40 like we were when we were really tanking in 2014. But outside of that big drop, this is significant. I mean, these are some of the other times that the DMI positive got so low, and it led to some really strong rallies to the upside. So the euro, and so the euro's really got some weak movement. That there's that blue line again. You can see we're pretty much right on it right now. Their trend quality, your trend strength indicators very negative, well below the cloud. So some real significant moves here. Here's the how far up we are on the 1 year chart. If I go back to more of a daily chart, you can see, we're kind of getting up towards this 62% retracement level, which can act as a resistance. And there's some volume up here over the last 5 years. So we'll see if this parabolic move runs its course at this resistance. So the other big mover today was not just the US dollar, but also long-term bonds. So long-term bonds, after having pulled back the last couple of days pretty sharply, really rallied today pretty hard. So that was coinciding, of course, with the drop in yields. Obviously not as big of a drop on the 10-year, and you can see here's the jump higher in the IEF, which is more associated with the 10-year. Not as big of a jump as you see here in the long-term 20 to 30 year. The near-term line is just bouncing out. It's pretty neutral, so we're not really trending one way or the other, but we are getting some pretty significant moves. Of course, the US dollar way up above. I mean, about as parabolic as a move as you can get. But TLT, you can see, all the moving averages, all but the 200-day moving average are cutting through today's range. So it's been pretty volatile, but it's also pretty darn neutral too. We are below the point of control, so we're not above that yet. But at least we are the 50 days above the 200-day moving average, and just like that, after a couple days below the 17, we're right back above the 17 and the 8 and the 50 and the 30, all in one fell swoop today. Commodities has also been a story lately. I've been trying to this bullish convergence down to the 50-day moving average, trying to bounce back up and get going again. Yesterday had a really good bounce back up above the 30-day moving average. We didn't quite follow through on that, so now the question is whether we will and stay above the 17 or get back below it and continue this convergence potentially into a divergence and fill in the gap between the 50 and the 200. So that's an important aspect. Remember, this is one of the three-headed monsters of risk appetite, IWM being the other, and then the third being emerging markets. And emerging markets are below its 1 year point of control, and we are in a death cross environment, and we are back below this, easily below 17. The 17 and the 8 are back below the 30. We are trending back down. with the 30 potentially crossing back down below the 50. And so we are in this mode here and at this 50% line where the risk trade can really get pretty bearish here. And that won't necessarily mean that the Qs have to drop per se, but it does mean that we might at least moderate down towards this 368 level. So that's kind of like when I say that there's some signs that we could get a little bit more than just a little pullback. Those are the signs, right? There are some signs that are out there that that we can this weakness can extend next week. It's more likely we'll bounce, and that from a technical perspective, and considering how strong the trends are. I mean, I know the trend is gone on IWM, right? The small cap index, the trend is gone. It's gone on the diamonds as well, but it's still very strong in SPY and still very strong in the Qs. So until that very strong trend, that very mature strong trend breaks, it's hard to break it. And so it's more likely we'll bounce and continue these very strong mature trends until something happens to break them on all of these, not just on the diamonds and small caps. So that's kind of what I've seen, but those are the signs I've talked about. And again, if you look at the sector rotation moves here today, so just look at the one-day chart here. And we'll go back to November, and then we'll do the 24th. And you can see that what were the big winners today were, energy stocks, real estate stocks. Of course, you saw that also in the asset classes, but then technology. So right now, this is your big winner of the cyclical areas. This is, of course, has been the big winner of your technology areas, and they were your big winners today. So, so again, if we continue this, then look for more of a sustained bounce. I don't see XLK, Y, and C underperforming. I don't see XLF, I, B, and F all underperforming because the energy outperform. I don't see the safe haven areas outperforming. So we're not really, you can see again that the bearishness is waning and setting up for some of these, whether it's the cyclical areas that buy energy or the technology-oriented areas that buy XLK, which one of those will grab the baton and lead us up on this next little grinding cycle higher. All right, for our trade idea of the day, I wanted to take a look at JP Morgan. And you can see JP Morgan has been kind of in a sideways. It looked like things were breaking out, kind of like with the Russell 2000, but then didn't. Just like the Russell 2000. So we had this good bullish intermediate run. The market sentiment, the intermediate line broke below its market sentiment, broke in the bearish territory, and no longer intermediate run. So now we're kind of more neutral. We are up off of the low, so that what bearishness we did have is ended. So we are off the lows there, and you can see the long-term chart is more neutral as well. We did get a red arrow last week, but we're back to green, so the trend is ending there from that perspective. When you look at the 3 green arrows charts, you can see we're back up above the 17-day moving average. Yesterday, we got above the 30. We broke back below the 30, but at least we're back above the 17. So we've kind of ended this run of filling in the 50 and the 200-day moving average. You can also see some of the other indicators here. Again, the DMI back between both indicators, back between 20 and 25. The RSI and the CCI, you can see they're both down into neutral territory after trying to get bearish. They got back up in the neutral territory. The Bollinger Bands, you can see we got into the lowest quartile, even dipped a little bit below that lower band, but then got right back up towards the middle, back towards the top of the value area. So what looked like, we were bullish, turned into a bearish trend just like that, and then now has gone sideways. So that gives us an opportunity to say, okay, well, let's come over here to the 160, sell the 160 strike, sell the 175 strike on the call side, and then buy a 177.5, buy the 157.5 for protection. So that gives us this long call, or iron condor, long call, an iron condor, excuse me, and then there's our trade. So our break evens, those lines that you see right here are pictured on the chart right there. So as long as we kind of mimic the November expiration cycles trading, we don't have to worry about earnings going into December. So as long as we kind of mimic that expiration cycle for December, then that's how we make our money. Obviously, you got good support below where we're at. You've got some room to run to the upside if it does continue to grind higher. But if it stays sideways, which is what you would expect considering all the neutral indicators, then that's how we make up to 474 on this trade, and then we'll risk a full position size, but out of that $1,000 we'll get out if we lose 474. All right, well, that does it for me today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Wednesday night, and have a great Thanksgiving weekend, everybody, and holiday, and we'll see you all next time.